Good morning or good afternoon, everyone, depending on what time zone you're in. Thank you very much for taking the time today to join us on this webinar, Empowering Investors in Disrupted Markets. My name is Mindy Gayer, and I'm the Southeast Region Business Development Manager for the Entrust Group, and I'll be one of your co-hosts for the webinar today. We also have Chris McAlpin, who is the managing partner from Sound Financial Strategies Group, joining us as a co-host. And we also have Clint Sorenson, who is co-founder and CIO of WealthShield LLC, joining us as a co-host for today. To help eliminate some of the background noise, everyone is going to be muted. If you have any questions throughout the presentation, you can type those in the questions box in the lower left-hand side of your screen, and we will answer those at the end when we open it up for the live Q&A. Before we get started, I have a quick disclaimer. Entrust Group does not provide investment advice, tax advice, or legal advice. We do not recommend or endorse any investments, products, or services. So we are not financial advisors, we're not attorneys or CPAs. The Entrust Group provides the record keeping and custodial services for self-directed IRAs, and all of the information in this webinar is for educational purposes only. We do encourage all clients to consult with your attorney, CPA, or financial advisor before entering into any sort of investment. During the webinar, I am going to quickly review a little bit about Entrust and self-directed IRAs for those who are not already familiar. Then I'm going to quickly touch base on the CARES Act and the impact that it has on retirement plans. Then I'm going to turn it over to Chris and Clint to discuss market sentiment and valuations. And then we'll have time at the end for the live Q&A. So again, if you have any questions throughout the presentation, you can type those questions in the questions box in the lower left-hand side of your screen, and we will answer those at the end during the live Q&A. First, I want to share a little background on our company for those who are not already familiar with the Entrust Group. We are self-directed IRA record keepers and custodians who specialize in holding alternative assets inside of retirement accounts for our clients, and we have been doing that for nearly 40 years. We have around 22,000 accounts, and that makes up about $3.3 billion in investor assets. And one factor that makes Entrust unique is our single point of contact business model that we offer our partners and clients. Most of our staff here at Entrust hold the CISP designation, which is the Certified IRA Services Professional designation. We offer national continuing education classes for realtors, CPAs, and financial advisors. And we also hold a national and local events and webinars. So if anyone is interested in learning more about those, please contact your local respective business development manager. We also sponsor an IRA Academy, which is where we actually teach the course that trains other people in our industry to pass the CISP course, which again is Certified IRA Services Professional course. All right, let's talk about what a self-directed IRA is quickly. So a self-directed IRA is a retirement account in which the individual investor is in charge of making all the investment decisions. A self-directed IRA provides the investor with a greater opportunity for asset diversification outside of the traditional market of stocks, bonds, mutual funds. So for example, inside of a self-directed IRA, you can invest in assets such as real estate, promissory notes, tax liens, REITs, precious metals. The spectrum of what you can invest in is very broad. I'm just naming a few. We'd be here all day if I were to mention all of them. But in order to invest in these alternative assets, you must have your account with a platform provider that offers the administration and custody of those assets. Entrust is the custodian and record keeper, and we will hold anything that is allowed by the IRC, which is the Internal Revenue Code, and that is administratively feasible. All self-directed IRAs are regulated by the IRC, which again is the Internal Revenue Code. And one other very important factor is that it is the investor's responsibility to do their own due diligence on the assets that they are investing in. So the custodian and record keeper does not provide the due diligence. It is the investor or the fiduciary's responsibility to provide the due diligence on the investments that they are investing in. All right, benefits of a self-directed IRA. What are some of the benefits? Well, it allows you to take control of your retirement accounts and diversify your retirement portfolio. You're also able to invest in assets that you know and understand the types of risks and returns that are associated with them. There could also be some tax savings, so your contributions could be tax deductible, and your earnings inside of those retirement accounts could grow tax deferred or tax free depending on the type of account that you have. All right, now let's quickly review the CARES Act and how it impacts retirement plans. The CARES Act was signed into law on March 27th, 2020, and it has some notable features in regards to retirement accounts. The first being 2020 RMDs are waived. So the requirement for individuals to take an RMD by April 1st of 2020 for tax year 2019 has been waived. RMDs due on December 31st, 2020 for tax year 2020 are also waived. So if you are required to take an RMD by April 1st of 2020 or by December 31st of 2020 for tax year 2020, that has been waived. The pardon from taking RMDs in 2020 include individuals who hold accounts as traditional IRAs, their beneficiaries, and Roth IRA beneficiaries. So the pardon is for, again, traditional IRA holders, their beneficiaries, and Roth IRA beneficiaries. This provision was created to provide relief to those retirement plan assets that have diminished in value as a result of the pandemic. Distributions taken before the bill passed, unfortunately, are not able to be undone. However, it hasn't been clarified whether prior distributions can be rolled back within the 60-day period. So individuals that have taken distributions within 60 days of this law going into effect, it has not been determined whether or not they can actually roll those back into the account. The next notable feature is the disaster relief distribution penalty-free. The stimulus bill contains disaster relief provisions that allow individuals to take disaster-related distributions of up to $100,000, and that's an aggregate, so a combination of all of your accounts, penalty-free for coronavirus-related distributions, and those are also called CRDs, that are made between January 1st, 2020 and December 31st, 2020. So if you qualify for a coronavirus-related distribution, you can actually take up to $100,000 in aggregate in distributions from your accounts penalty-free if you are not of retirement age. Now, while it's penalty-free, the tax liability is not waived on the distributions. So you have to pay the tax. The tax liability may be spread out across 3 tax years into 3 equal amounts. So the penalty is waived, the 10% penalty is waived, but you are responsible for the tax liability, and it can be spread out across 3 tax years into equal amounts. The amount of the distributions already taxed may be repaid 3 years from the date of each distribution. So the date that you take the first distribution, you have 3 years to repay that if you wish to do so. And the date that you take the second distribution, you have up to 3 years to repay that if you wish to do so. All right, who is qualified to be an individual to take these coronavirus-related distributions? Well, any individual who is diagnosed with COVID-19 would be qualified. Anyone whose spouse or dependents has been diagnosed with COVID-19 would be considered qualified, or anyone who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having work hours reduced, being unable to work due to lack of childcare, closing or reducing hours of a business owned or operated by an individual due to COVID-19, or other factors as determined by the U.S. Treasury. So all of those that I just mentioned would potentially qualify you to take the coronavirus-related distributions penalty-free. Again, tax liability is still on you. It's just waiving the 10% penalty. The final notable feature of the CARES Act in regards to retirement plans is the increase in the 401k plan loans. Normally, inside of a 401k plan, profit sharing plan that has loan provisions, under a plan, they allow participants to borrow up to the lesser of 50% of the vested balance, up to $50,000. With the new CARES Act, it actually increases that 50% of the vested balance to 100% of the plan's participant vested balance, and increases the $50,000 cap to $100,000. The amortization of the loan cannot be longer than 5 years unless it is for purchasing a primary resident. So that's one key thing to note. And the loan must be repaid back quarterly to avoid taxation and penalty on the unpaid balance. Payments on current 401k loans can also be delayed for the year according to the CARES Act. The provisions of this CARES Act were intended to ease some of the financial strain many families are currently experiencing due to COVID-19 pandemic. All right, that concludes my portion on Entrust and the CARES Act. So now I'll turn it over to Chris and Clint to discuss market sentiments and valuations, and then we'll have the live Q&A after that. So as I've mentioned, if you have questions, please type those questions in the questions box and we will answer those at the end.
Thank you, Mindy. And that was the clearest and most concise presentation on the CARES Act that I've heard at this point. So I appreciate that. My name is Chris McAlpin again, and I'm the managing partner at Sound Financial. We're an investment advisory firm in Jackson, Mississippi. And I'm joined by Clint Sorenson, who is our lead investment strategist, and he's the chief investment officer and partner at WealthShield in Raleigh, North Carolina. At Sound, we work with the end user client. That's the person investing money, the retiree, the family planning for college, the business owner planning an exit strategy. ESG investing and faith-based investing is a favorite topic of ours. And Clint and WealthShield focus on the industry professional. They manage assets at the institutional level, running money for different types of firms, but all with a trend-following methodology. And so that is our investment philosophy. We use a rules-based system that is built around those trend-following methods. And for our clients, that means that their portfolios are built in the traditional model of stocks and bonds, and then overweighting or underweighting based on market direction, whether we're seeing overweighting of large caps or small caps, or dividend or growth, or high yield and treasuries, all based on market direction. And we use this as a signal to take our clients' risk on and risk off. And I say this only just to give you a perspective of how we look at the world at Sound and how Clint looks at the world at WealthShield. And so on February 28th, our signals took us risk off. And no, we don't have a crystal ball. The global pandemic is that kind of black swan event. And in our world, there is no predicting black swan. No, there's no predicting that type of event, though. I suspect that a lot of people will be claiming that they did so in the future. And so there's little that you can do in the investments to plan for something like that, except for have a plan in place of how you're going to react to adverse conditions like we see today. And so when our credit spread, it took us risk off within a week of the market peak because markets moved that fast. And 1 week of a signal like that is lightning speed. And therefore we want to primarily talk about these 3 areas today. So the economy, the markets, and the future. And unlike past bear markets, I remember going back to 08 and 09, and some of you remember this as well, there's a lot of kind of sense in the general public of what is going on. Why are we in a financial crisis? You heard weird measurements like the TED spread, and why would Bear Stearns go out of business? Haven't they been around for eons? But now, today, this is very different. COVID-19 is a global pandemic. We see it all over the news. And today, we have this national argument going on about reopening the economy. Or at least in the media, there's this debate, or this so-called debate between medicine and economics. And medical professionals and leaders see a great threat to people's health, and they want to defend people by keeping them healthy. And economists and business leaders see a great threat to the economy, which is also a great threat to people's health because it affects their livelihoods, their wealth, and their future. And most of the leaders that I've heard from, that I've read or I've heard speak or I've talked to on this topic, it's not about the money, but it's about people's lives. And most good scientists and leaders will admit when they don't know something. And there are plenty of unknowns right now. And so therefore, we want to look at what we know, and in times like this, make sure that your knowns are truly knowns. Can you measure them? Can you define them? Do you know what you're looking at? And we want to attempt to define what we don't know. And this is difficult because the nature of an unknown is that it's unknown, right? But if we can define the unknowns, then we can do better work. And then the rest is just fog and noise, and hopefully we can clear a path through that, or at least see our way through it. And the way that we do this is with our framework. And so with our framework, we want to clear away the noise and define the key measurements that we look at. So Clint, would you walk us through our framework, please?
Yeah, absolutely. So Chris, I appreciate the introduction, and I appreciate everyone's time today on the call. So the way we developed our framework was essentially based on the theory, which we believe to be true, but obviously it is a theory, that the business environment cycles. So it goes through accelerations and decelerations, and that business cycle leads ultimately the market cycle, or at least runs concurrent with it. And so that's really important for us to understand and to measure and to look at, to ascertain where are we? Are we in a positive environment where growth's accelerating, or are we in a negative environment where growth's decelerating? And so that's what we focus on, and we look at 4 different pillars, or 4 pieces of that puzzle. And those are valuations, which give us a really long-term view. So how cheap or expensive are markets globally. And then that really informs us on how to make decisions from an asset allocation perspective, really with that 7 to 15-year time frame in mind. So, having that long-term view. Now, that's all well and good, but what about the short term? What about the intermediate term? Well, that's where intermarket relationships or market sentiment comes in. That's where we measure short term. So think 0 to 2 years is really where that works well. And that's what Chris was talking about in terms of following the underlying trends in the market. It kind of follows this philosophy that the market's always right in the short run, and then we just follow it. So if markets are moving risk off, we go to the things that are positively trending. If the market's moving in a risk on fashion, we go into the market, right? So that's kind of the way we follow market sentiment, and I'll go over some of that in a little greater detail as we get into the questions. And then the next 2 phases are economic growth and monetary policy, which really run hand in hand. So how is the economy? Is it accelerating, decelerating? How's inflation? Is it accelerating and decelerating? And what does that mean for monetary policy? And that really informs or affects asset prices on an intermediate term basis, so 2 to 8 years. So the way we developed the framework was to get an understanding of not only the broader, longer term macro cycles that we understand with valuations, right, how cheap or expensive things are, but also down to the short term, 12-month movements of any particular market or market environment. And so by understanding those 4 components, we can get a really good measure at whether there's more risk or more reward present in the current environment. And that's how we steer our investment decisions. So it's not about predicting the future. It's simply about taking the data and taking the environment as it is today and making the best decision we can make. Because there's really 4 types of bets when you get into the market. There's good bets, there's bad bets, there's bets you win, and there's bets you lose. And what we're trying to do by identifying a framework for navigating markets is to magnify the number of good bets we make, and the outcomes, hopefully, if we do that with discipline, will be the ones that work. Not always the case, but that's exactly what we're shooting for. And so that's how the framework was built and why it was built that way.
And so, Clint, when we look at our framework, and economic growth is our 3rd piece on it, it's our 4th piece on the screen. But we now see the economy is opening back up. All 50 states are attempting to open up their economies in some format. What do we see happening throughout the nation right now? What do the numbers tell us?
Oh, it's absolutely terrible. So economic growth right now. This chart's telling because this was as of March 31st. As you update it through the end of April, and as we'll update it through the end of May, you'll see this in all the way in the red. So the reason this is important at this snapshot is because the economy was actually already slowing pre-COVID. So the economy started slowing globally in early 2018. The cycle actually peaked in February of 2018. If you look at global PMIs, world trade, global industrial production, so global manufacturing, look at several countries and you really dig in globally, you see that the economy actually peaked in early 18 globally, and then here in the US we peaked in October of 2018, and we have been actually in an economic slowdown since then. And that was the reason we had that fourth quarter shock to the system in 2018. That's why the Fed went from tightening policy. So you see them on this thing, monetary policies all the way green. They were all the way red. They were raising interest rates and they were winding down their balance sheet through quantitative tightening. That was about as bearish of an environment as you could have. And all of a sudden, they switched gears. They started cutting interest rates through 19 and then started expanding their balance sheet in the fourth quarter of 2019. This is all because we were slowing down. And so many people get fixated just on the markets, they miss the bigger picture. And the bigger picture was we had really high valuations, we had slowing economic growth, and we had bad monetary policy at that time. And so then you had this bad economic environment or slowing economic environment. All of a sudden you get fuel thrown on that fire, and that was what was COVID-19. And so now we've had disastrous data. We've had over 16% month-over-month declines in retail sales. We've had industrial production down 15% year over year. We have GDP tracking at being down close to 40%, if not more than that, in the second quarter once we get those numbers. It's obviously not a very good situation. We have unemployment close to 20% now. We have 39 million people unemployed. It is for sure a dire circumstance. And those data points I rattled off, GDP, retail sales, industrial production, and employment, those are the big four that the National Bureau of Economic Research looks at when determining whether we're in a recession or not. And that's not really important to our work, Chris, in terms of what you and I do on a day-to-day. All we're trying to measure is whether we're slowing or growing, right? Whether we're slowing or we're expanding. And it's very much the reality today is that we're contracting, and hopefully we'll be contracting at a slower rate as more and more data comes out and we kind of get out of this trough. But we're far away from resuming growth trends.
Sure. And about a month ago, we were hearing a lot of V-shaped economy talk in the news, and the news rattles off different slang terms like that. And for those of you who don't know, that's just the way that a chart will look if the economy were to fall drastically and then recover extremely quickly. It would make a V-shaped on the chart itself. Clint, the V-shaped economies happen. Economies now, not markets, economies.
Actually, all economies V-shape. So all economies have V, right? Like if you look at year-over-year percentage change of any of those four data points I just rattled off, or if you just look at GDP to keep it simple, and you look at year-over-year percentage change, every single recession in history since we have data. So if you look at GDP, you're going back into the 40s. If you look at industrial production, you can go back to the early 1900s, and we can see that they all V. That means they all fall. They get to some point, and then they start to recover. However, what people are missing is that doesn't mean you're expanding again. And so that's really what the nature of the question is when do we get back to growth? And so I think that's a very different question. Economies don't just bounce back to record growth after a very deep contraction. That's just not what happens. So from that sense, they don't V. But from the look of the chart, of course, all economic variables V. But economies take a little while, right? We just got a report this morning that 42% of the jobs lost are most likely going to be permanent, at least for the foreseeable future. And that is not a V-shaped recovery. And obviously who knows what's going to happen with COVID in the future. But if you get some sort of second wave, and you have these rolling lockdowns or rolling scares, then it's going to take a little while to get back to positive economic growth.
So let's talk about our day job, and that's the markets. Why is the stock market responding the way that it is? Because we've got probably the biggest disconnect between the market and the economy in the last 20 years, or at least I can speak for my career that I've ever seen. So why is it doing this?
Yeah, actually, if you look throughout history, and there's a famous chart that kind of goes through the emotions of the market. And it says this time is different at the peak, and then it falls, and oh no, the bear market started, and then it's rallied. It says, okay, we're back to normal. We're in that back to normal phase, right? We had a significant decline, a very fast decline that took markets to the most oversold conditions we've witnessed. And you had the Fed step up and United States Treasury step up in combination with the Fed, and they said we are going to do whatever it takes to support liquidity. We're going to do whatever it takes, and actually, in the Chairman Powell's words, make investors whole, make them whole. And so they stepped out and they said they're going to buy ETFs, they're going to buy corporate bond ETFs, high yield ETFs, which has been unprecedented. They're going to expand the range of assets they buy. They're going to provide a lot of dollar liquidity to foreign central banks, which buy U.S. stocks, and that liquidity, coupled with very oversold conditions in a market that probably gone too far too fast to the downside, creates this perfect environment for what is still today a counter trend rally. And that just means that the broader trend, we're still below the peaks that we made, where everything still suggests that we're underperforming treasuries and defensive assets, and everything we measure on a 3, 6, and 12-month time frame are still trending negatively. So that's a trend. This is more of a really short-term phenomenon and counter trend bounce that we hope moves to new highs, and we break out and the market continues to run and we move back into positive trends. But right now what we're just experiencing is a very sharp counter trend rally, which is actually pretty typical for what you see during these type of recessions, right? You can go back to every recession. If you look at 1901 and 1921, you had a lot of fits and starts in terms of the way the market declined, but over that entire time frame, it went down more than 60%. Same thing with 1929 to 1942 when we finally bottomed. But you had a lot of declines and rallies. If you go to recent years and you look at the Dow Jones in 2000 to 2003, it chopped around and had several rallies and falls, almost reaching new highs, 3 different instances before actually making its bear market low in December or in March of 2003. So, and then even more recently in the global financial crisis from March to May of 2008, if you look back at some of those reports and some of the news back then, it was like, oh, Bear Stearns was just a flash in the pan. Everything's going to be all right. We're headed off to growth again. This is very typical. Markets are doing exactly as expected. And if you look at what's trending positive, right, and this is what gives us the best information, the markets that are trending positive still today are treasury bonds, they're gold, it's the US dollar, it's things like Bitcoin, it's alternative investments, especially those of the risk mitigation variety. So call it long short strategies where they keep low nets and add a lot of value in the short side, industrial real estate. It's like these are the things that are trending positive and the things that we're more favorable of from a portfolio perspective than allocating to the S&P, for instance, which up until today has been below its 200-day moving average since the end of February. And so I think you just got to focus on where's the positive trends, and those positive trends are presently not in the U.S. stock market, and it's doing exactly as it should do. It's going to bounce around within that broader trend.
So let me go back to the original way that I framed the conversation of what are our knowns and what are our unknowns. And you just said a lot about the markets right there. So is it fair to say that it's unknown what the Fed is going to do with statements like make the investor whole? no Fed chairman's ever made statements like that. No Fed has ever bought ETFs. We don't know how they unwind those off their balance sheets, right? You and I've discussed this. So, how do they get rid of that? Because if they start selling it in the future, it creates other kinds of problems. What are they going to do? But we do know that we've had these counter trend rallies in every market, every bear market in history, or every extended bear market in history. Is that a fair statement to say it that way? That
That's
this
right.
is normal? This is natural?
This is natural.
Okay, fine. And so that to me kind of gives it a picture of it's not all doom and gloom. That we look at the valuations that we've discussed in the past, and ladies and gentlemen, when we came into this market, we were the U.S. stock market was the #1 most overvalued stock market in history, or as in the modern history. Let's say it that way. It surpassed the .com bubble in overvaluation. And I believe it's fair to say that even after March, after a little bit of the rally into April, it was the second most overvalued. So it was set up for a tremendous fall. And the bright side of that is that as markets cycle, as economies cycle, it gets kind of the junk out. It gets kind of the fluff out. And we can see a lot of growth in the future. And so, Clint, maybe we can talk about that in just a second, but I want to kind of pitch it back over to Mindy and see are there types of questions you want to dive in on this conversation with us? I know you like to talk the alternative route at times, Mindy.
Yeah, I'm going to stay out of the traditional market conversation. That's not my area of expertise.
Okay. So, Clint, go back to the positives. What's trending positive now? You said treasuries, gold, dollars, crypto, and maybe lead into alternative investing for us as well.
Yeah, industrial real estate, certain market neutral strategies, long short hedge funds that have been allocated essentially to low net exposure, so they do really well on the short side and they're not really exposed to the broader market. They've done extremely well. Industrial real estate's probably been one of our top performers that we look at. But I think essentially when you're looking at your allocation, Chris, you stated it best. Like, let's look at the knowns, and I'm going to bring it back to the framework. If you look at valuations in the U.S. right now, which this does not reflect, but reflect at the close of business at the end of this month. So I'm giving you all a preview. Valuations are back where the Buffett indicator, which is market cap to GDP. I did not invent it. He said in a Fortune article in 2002 that it was the best measure of market valuation that he's seen. And this is coming from Mr. Buffett, who has got quite the track record. Although a lot of people are throwing him under, throwing some shade on him recently because they're saying he's not that good. But look, just because he sold his airline stocks in a counter trend rally, he did exactly as he should. Just because he hasn't deployed his cash when valuations are this high, he's done exactly as he should, in our opinion. But that valuation indicator is now at 144% of GDP. Now, just to give you a point of reference to Chris's point, in 2000, that indicator reached a peak of 136.9%. It's at 144% today. So we are higher valued today than we were at the peak. And that wouldn't concern me as much if that wasn't accurate at forecasting forward returns. So that tells us that if you just buy and hold the S&P 500 from here, you're not going to have a really good experience. And it's not a great place for clients, in our opinion, from a valuation perspective. You're looking at negative returns most likely over the next 10 years on average. Now the path, who knows what will happen, but that's historically what is set at these valuation levels. And that's just not enough for the risk that you're taking, especially in the middle of a very deep recession. That even in a recovery, you've got depression-like numbers now, recovers to just a less bad recession, right? It doesn't recover immediately to growth. So I think there's a very big risk in positioning in public assets. And we can do it another example, right? And this is what the Fed has done so masterfully, is they turn cash to trash by giving you zero on your savings, right? And they're turning that negative. They've now turned bonds to cash. So you get 0.66% on a 10-year treasury note, right? Which is absolutely nothing. And now they've turned stocks to bonds. So what does that leave you? That leaves you private assets. That leaves you alternative investments. You have to get creative to be able to generate a future return stream, to be able to generate attractive returns. You're going to have to employ trading strategies in public markets if you want any kind of hope. And so when you're looking at that, that's what the Fed has effectively done through policy in order to restore liquidity. And that's created an environment that, in our opinion, is ripe for alternative investments. And so, again, what we like is based on the economy today, which is a slowing economy, we want to be focused on those things that are risk mitigating within alternative investments, right? So things that are cash flowing real estate, things that are pretty resilient, like industrial, warehousing, some multifamily, like that's where we want to focus. Market neutral, global macro strategy, some precious metals, tail hedges, certain crypto. But when we start moving into the recovery, right, when valuations get more attractive in certain segments, when we start moving into recovery, then we start looking at things like private businesses or traditional private equity, venture capital. Those are the areas you'll want to move to once we move into a recovery. You want to look at different types of real estate, willing to take on more development projects. And I think that's how this thing will evolve over the course of the next several quarters, is we'll move from this very defensive posture from an alternative perspective to a very offensive one. And we're already seeing a lot of these venture capital, a lot of these late stage private companies trading at over 50% discounts to their valuations last year. And so there's going to be a really unique opportunity in distressed credit, venture capital, and other private strategies as we move into a recovery.
So what's the brightest thing? What is the brightest asset growing out of the bottom of this, Clint? What's the one disruption we should look for?
Yeah, so the Fed has solved liquidity, right? They jumped in, piled a bunch of liquidity in partnership with the Treasury. We heard the word SPV again, right? So special purpose vehicle, brought back memories of Enron, and that's a very strange feeling when we're listening to our Fed and our United States Treasury talk about special purpose vehicles, and I think Enron. But nevertheless, that's what occurred.
Yes.
And so
we're in Jackson, so we think WorldCom.
That's right. So they brought back the special purpose vehicle, and they solved liquidity, but they haven't solved insolvency. And so I think there's going to be quite a bit of bankruptcies that occur. We're already seeing them, right? And I think you're going to continue to get downgrades and defaults. And from a risk reward perspective, that presents a very unique opportunity set in distressed debt. And so I think distressed debt will probably be one of the best performing asset classes coming out of this. And I'm talking phases here. So I think that's your first phase. And Chris, you know very well about following credit spreads. Credit spreads will give you the key to that, right? As you see credit spreads really blow out, you're seeing bankruptcies as they start to compress again, and you're through a good chunk of those, you'll be able to really pick through the wreckage and find some good opportunities in there. So that's first and foremost. The second stage will be in public markets, small caps. So small cap equity relative to large cap equity. And then it's going to be global equity relative to large cap equity here, right? Domestic. So I would say buy global stocks over US stocks and buy small caps over large caps. And the reason why is when you get into a recovery, small caps in value tend to do really, really well. And if you look at the disparity we have now between small caps and large caps, for instance, it is absurd. And we have been in a very bullish trend for really 5 names, which we call the FAM stocks of Facebook, Alphabet, Amazon, what's the other one? Apple,
Netflix, Microsoft, Netflix, and Google.
Yeah. So those are the ones that have really carried the benchmark. It's made up of about 21% of the market cap of the S&P is now in those 5 names, and then about over 40% of the NASDAQ. And if you look at the NASDAQ now, it's actually has a higher market cap than the rest of the world combined. So I think that's one of the greatest trades ever, to just go long the rest of the world, where you have expected returns in emerging market value according to GMO at about 10.8% per year after inflation. In the US, you're looking at negative returns. That's a really good trade for the long term. And then I also think going long value over growth is another good trade. Now, when you move into the expansion, so that's your recovery phase. When you move into the expansion, you want to start focusing on factors that can benefit from that. That's where commodities will take place. So maybe it's on the back of an infrastructure bill. Maybe it's on the back of just inflation expectations due to all this money printing. Maybe that actually comes, although it proves to be more deflationary in real time, maybe it does turn into inflation down the road. But I think that pivot to commodities, which are at 50-year lows relative to the broad market, relative to the S&P, I think that presents a unique opportunity as well. So I think first, it's small cap, it's venture capital, it's value, it's emerging markets, and emerging market value, and then it's moving into things like commodity and more momentum-based trades and more growth. And so I think that's the way it evolves. Now, stay focused on managing risk, but when we start to get a recovery and when these indicators start to move back towards a favorable environment where reward looks better than risk, I think those are the areas and really in that order that you can start positioning.
Sure. So Mindy, do you want to?
Question. Yeah, I have a quick question. You're mentioning these investment strategy phases. Would your retirement age have any effect on these investment strategy phases that you're referencing, or is this kind of a one size fits all?
Yeah, so absolutely. In terms of the type, when we start sourcing the actual type of investment, whether that be in alternatives where we're having to look at lockups and where time horizon really does become applicable, yeah, absolutely, it matters, right? An individual's objectives and constraints, which would be your, the tax situation, time horizon, i.e., retirement age, legal, unique, all the different individual constraints that an investor may have are definitely going to be important in terms of fitting in the proper investment for the time. But broadly speaking, those factors do work, and we can apply those across the board, right? So we know in a slowdown or economic contraction, we know high quality is the top performing factor, right? And keeping volatility low on the portfolio is important. We can do that across asset class, whether that be in fixed income, just focusing on treasuries, or in equities, if it's an income-based investor focused on dividend growth or dividend income. There's ways to get exposures to those factors that can fit an individual's objectives and constraints. But thank you. I think that was a great question.
And Mindy, when it comes to the client, especially the retiree, the client optics matter a lot. Are they comfortable with the investment? Do they understand the investment? And walking through them and helping them understand it and say, okay, if we're just using stocks and bonds, but we're using a lot of the alternative strategies, whether it's a credit spread or whether it's a trend following signal to mitigate risk, you want to make sure that they understand it so that they're comfortable. If we do delve into some type of alt strategy, a lot of people do get uncomfortable with them because they don't flow, they don't make sense the way that we sometimes want a stock or a bond to make sense to us.
Got it. Yep, that makes sense. What sort of questions are clients asking right now? Can you speak a little bit about kind of what all types of questions you're getting from investors on the alternative side and the traditional market?
Okay. Where I'm getting a lot of the questions, or where our firm is hearing questions from clients, are around what's going on in the markets. Why has it bounced so far back, and have we missed it? We all have a fear of missing out, Mindy, and we all have this fear naturally anyway. But because we are also in touch with the news, we can track what's going on in the markets all the time, whether we need to or not. We have a fear of missing out. And so I think the biggest mistake, or the biggest question that I get a lot, and we have to talk a client through this, do not jump on this bandwagon right now. Do not. If we're wrong, then, hey, we're probably going to see great growth. If this really is a V-shape, then it's gone, and we're going to get growth after this. Okay, you can go participate in it there. But the fear of missing out, the questions around that, and so we get into that, and we kind of talk about what we've talked to on the stocks up until this point. The other one is just the questions around the unknown. What could possibly an economy look like in the Great Depression? Well, you're seeing a 2020 version of it, at least for one quarter, and we hope it's just one quarter, but we're seeing those Great Depression type of unemployment numbers and GDP numbers right now. So I think a little bit of that is surreal of, wow, I'm watching this, I'm seeing this in my life. And a lot of the other conversations that we have with clients right now are, all the safer at home stuff that we're all going through. How many books can you read? How many Netflix shows can you watch? And gosh, I wish I could see my grandkids. I think that side of it is I think we're all dealing with that. I'm not saying my grandkids, I have my kids at home, but I think that's the real normal side to this. So unlike any bear market I've been through, this has been different because we all understand what's happening.
Great.
I think a lot, Mindy, the other surrounding questions are, what are we going to do coming out of this? What does the return to normal look like? And we'll stick with an area just in financial cases. The markets continue to function normally, and they were definitely tested in March. The sell-off, both in the stock and the bond markets, tested the functionality of the markets. They worked very well. I think a lot of the other questions of, are markets going to continue to function normally? How does the New York Stock Exchange run if nobody's at the New York Stock Exchange? Well, every other market, like just about every other market in the world, is run via computer anyway. So the New York Stock Exchange is kind of a dinosaur in that way. What happens if they don't function normally? Well, that's what we saw the Fed step in March and just forcing a ton of money into the markets. That was the backstop that allowed the markets to function normally. And so we don't have runs on banks with people standing at teller lines anymore. They happen in markets at times. And the Fed did a really good job of defending the dollar by stepping in the bond market and pushing liquidity through. And so when we get into these kind of wonky parts of the presentation of liquidity events and the Fed insured liquidity, that is important to every American that we insure liquidity. I go back to 08 and 09, and I remember everybody being so mad that AIG got a bailout. And I remember telling clients, AIG backed up every money market account that we had. You wanted them to get a bailout. Now, that was not very politically popular. That was, whether you're a Democrat or Republican, that wasn't a popular idea a lot of times. But sometimes leaders just have to make those kind of hard decisions and step in and do that. In this case, the Fed did a really good job of stepping in the markets this time and forcing a lot of liquidity through. We didn't want to see the result of what would happen if they had not done that. So I think that is another point that people watching the news are touching on. What happens if that breaks? Well, they've done a good job of ensuring that doesn't break. And what do portfolios look like coming out of this? I think the Fed will probably push people more into risk assets. As Clint said, that a stock now looks like a bond. And just simply meaning that it moves like a bond used to move, a little more stable, a little more boring, and a lot less return. Maybe this market cycles, it cycles down to the bottom, and that changes. We get more traditional asset classes acting like their traditional class. So I'll stop there because we'll end up in some real nerdy space if I don't.
All right. Well, Chris and Clint, did you have any other questions you wanted to present? If not, we'll go ahead and go to the live Q&A.
Yeah, I think we jump into Q&A. It's great. Chris, did you have anything else on your list?
Say that again?
Did you have anything else on your list you wanted to go over?
No, I'm good. No.
Okay, perfect. Well, thank you both very much for the informative update and overview on market sentiments and valuations. It looks like we have one or two questions in the Q&A box. I'll go ahead and read it. I think it's going to apply to both of y'all. It says, with the QE stimulus and bailouts for major corps, I see a collapse in the US dollar as the world currency. The Fed's endless manipulation of the economy through interest rates and monetization of expansion of the M1. What options of investments would you be looking at if this possibility is in our near future?
Yeah, it's a great question.
I knew you would have to jump on that, Clint.
Yeah, so great question. And, this is a common fear among a lot of people when it comes to what happens when the Fed does all this QE and now partners with the Treasury to do this, right? And it's really just an incredible amount of stimulus and money supply being pumped into the system. Well, for a collapse of the dollar, when the dollar moves up, and the dollar's moved up throughout this entire time, dollar's still in a positive trend, as you heard me mention earlier. The reason that is the case is that the enhancement of the money supply is not necessarily inflationary in and of itself. You have to have money velocity. You have to have money exchange hands. And so you can increase the money supply all day, but velocity has completely fallen through the floor. And that has been a problem. That's been a big problem. And that's why we haven't had any inflation. And that even though we've done QE 1, 2, 3, 4, Operation Twist, all this other stuff, right? Supporting the repo markets, just really enhanced the balance sheet and expanded that and kept interest rates low. It's been more deflationary than inflationary. And that's because we cannot print jobs, we can't print income, and we cannot print velocity. And so that's really you have to have that to have a hyperinflationary collapse of a currency. The other thing you have to have, which we don't, is you have to be borrowing in a foreign currency. And so that if you look at throughout history, every major hyperinflationary event has had one thing in common, and that is that country borrowed in a foreign currency. And when you do that, that becomes a big risk. And so hyperinflation is probably not in our future as long as we're the world reserve currency. Now, you did say you could see the collapse of the US dollar. Hopefully I solved that issue. Now, what could bring that about would be a new currency system. Special drawing rights with the IMF, which they're ushering in. And if you look at it, 90 countries, we got this news today, 90 countries have requested bailouts from the IMF. So that is ushering in a new global currency. That bottom line, those bailouts equal global currency. And so when you're seeing that occur, I could make the case that the US becomes part of this global currency. And if that is the case, then there would be the capability of borrowing in this new global currency or special drawing right. And in that instance, you could see the collapse in the dollar. But we're way far away from that. If that does occur, you're going to want to be in the people's currency, things like Bitcoin, right? I mean, regardless of what anybody's opinions are, and especially Goldman's this morning on Bitcoin, but Bitcoin is the people's currency. It's a peer-to-peer network. It was exactly created for this, so that people couldn't. So it had a natural supply and demand mechanism to it. It's backed by a peer-to-peer review system. It's secure money, and at the end of the day, well, not really. Doesn't satisfy all the necessary things of a currency yet. It's a good hedge against an end of the world scenario, like you mentioned. The other thing is gold. Gold has been money for forever, and that gold has stood the test of time while every fiat currency has met its demise. And so this is what happens. Global currencies that are tied to nothing, they meet their demise eventually. And so gold has stood the test of time through that. And so I would say gold's a good investment, as well as things like Bitcoin for that potential scenario.
And I would add also a great question. I was laughing at Clinton. I wasn't laughing at the question. I love the question. Clinton and I have this debate all the time. Think back in history a little bit, and it took 2 world wars to unseat the previous world reserve currency, the pound sterling. Now, granted, after World War I, the U.S. dollar was the unofficial world reserve currency, and England had borrowed from the U.S. So that's where that started to unravel that. It takes a lot to unseat a world reserve currency. You know, the old saying, if you're not sitting at the table, you are what's for dinner. In this case, the dollar or the U.S. we're certainly at the table. We're at the head of the table. It does take a while for that to unwind. It's not a bad exercise at all to have a plan in place if that were to demise. But I think for one, it's kind of down the road. I don't see it happening in the near term. But there's a couple of superpowers out there, or want to be superpowers, that certainly would like to see it, and then Russia and China.
All right, excellent. Well, thank you for the explanation. All right, looks like there's one or two other questions here. It says, what type of self-directed investments do you think make the most sense right now? How concerned are you with potential inflation? And I'm going to pass that to y'all since we don't provide investment advice.
So you say what type of self-directed investments?
Yeah, so what type of self-directed investments do you think make the most sense right now? How concerned are you with potential inflation?
Yeah, so
Clint, you tackle inflation. I can tackle the other one.
Yeah, I would say self-directed investments too. I'll tackle that really quick. I think that's things like right now for the current environment, it would be things like industrial real estate. I think that's offering some promise in a recovery scenario. As we move into that, there's going to be other areas of real estate that are going to present an interesting opportunity. And I still like precious metals and gold here. You know, when you're in a growth, inflation slowing environment, that's a promising investment. Eventually, which I'm not worried about that right now. We just haven't seen it, you know, the signs for necessary inflation. But if we do get it, it'll be readily apparent in the dollar. The dollar will start to lose value. When the dollar starts to lose value, that is inflationary with about a 6-month lag. And so when that starts to occur, those precious metals investments should help you kind of stay the course, but also moving into more real estate, moving into commodities, I think is the proper pivot there. So commodity strategies are going to be a really unique opportunity set when we do get inflation, but a matter of when we get that, not sure. I'm not really worried about it either. It's just when it happens, you just react to it. And those pivots historically have worked really well. And moving into commodities and out of things that are more inflation sensitive, like stocks, are typically a really good play. So private investments in general will work in that type of environment.
Okay, great. Thank you. It looks like we have another question. Is update framework dashboard available somewhere?
Yeah, so if you just reach out to Chris McAlpin, we'll get you the updated slides. So we'll have that updated for you actually at the close of business this week. So as soon as it's over, as soon as the week's over, we'll update everything and it'll be ready on Monday.
Excellent. It looks like that is all of the questions, unless anybody wants to ask any last minute questions. I'll give you a minute here to ask. All right, I don't see any other questions coming through. However, if anyone has questions, you have all of our contact information on the screen. Please reach out with any questions that you have. Chris and Clint, I want to thank you very much for co-hosting the webinar today. Appreciate all of your very informative information. And I want to thank everyone for joining us on the webinar today.
Thank you, Mindy. Appreciate you.
Yeah.
Yep. Thanks.